Bloomberg Audio Studios.
Podcasts, radio, news.
We're going to turn now to the world of private credit. Blue Owl Capital reporting earnings this morning, matching estimates. We are joined now by Blue Owl's co-CEO, Marc Lipschultz, for an exclusive interview. He was also just recently announced as a future co-owner of the Tampa Bay Lightning NHL team. We are going to talk about that too. Sports is a big asset class right now. But first, with earnings, private credit also a very big deal. 14 quarters in a row of growth you guys have had. You're sitting at records when it comes to fee-related earnings, and it was all borne forward by that private credit boom in a big way. What does this look like moving forward? Because when you talk to investors, there's a lot of question about how things change under a new interest rate scenario.
Well, thanks again for having me here today. And look, it's been a very, very good chapter for Blue Owl. We have had 14 consecutive quarters since we went public. We have grown our fee-related revenues at 35%. We've grown our fee-related earnings at 32% and our dividend at close to a 30% rate. And we're quite excited about the next chapter. You're absolutely right. Our origin, our roots lie in this direct lending business, which continues to grow and evolve. And its next phase ahead lies in places like asset-backed lending. There's new areas emerging around our real estate business, like hyperscale data centers. So actually the future is very, very exciting from where we sit. Look, we offer something different from many. We don't offer all products to all people, but we offer what we believe are really the best of breed products, market leaders in a set of products that are about downside protection, durability, and predictability, and that's what Blue Owl itself is about.
You know, when it comes to products itself, you guys have expanded very meaningfully through acquisition. You have made a number of acquisitions this year in a very quick time frame. And I think when people look to the future, the question is, are you going to spend now time integrating those assets, or are you still looking to buy more?
Well, look, the integration starts day one and frankly, long before we close. You think about businesses we've already acquired, we've got full integration and ready to roll together as a team. The thing about our acquisitions has been, and I think will continue to be, really marked by the following. You can build a product, organic development, and we do that where we have a unique, distinctive capability that just doesn't exist in the world. So triple net lease, our real estate strategy, in Europe. We're already the market leader in the world in that business. We'll take it to Europe. But where there are other areas of opportunity that fit that DNA of downside protected, income-oriented products, then we want to look and say, do you buy or do you build? And I think we've landed in this spot that's a little bit of the hybrid between the two. We work with and join forces with an incredible team, like in the case of Atalaya, having the team join IPI. The team is joining. We're not buying their business, we're combining with the business, and then together we're making that a better opportunity for the investors in the funds and for Blue Owl shareholders by accelerating the growth.
You know, it's interesting. You are a large private credit firm, real estate firm, private assets, but you're publicly traded. And when you look at others in the industry, Apollo, for example, there's this pitch that public and private are going to converge, that private credit is something that can be more easily traded. They're even building a trading desk to make that possible. Do you think that that's true, that all of a sudden you're going to look up one day and you can't tell the difference between public and private? Is it possible to make these markets be more liquid?
So a couple observations. Public and private, I might prefer the term, are increasingly adjacent, which is to say there are certainly areas that are bringing them closer, right? We have this whole family of continuously offered so-called products. We're designed for individual access, customized, but the same investment experience as institutions. And so I think there's definitely this increasing adjacency. But on the other hand, private markets are private for a reason. Our whole value proposition to the user of our capital is, look, you're going to pay us a premium and you're going to sign up for a much more restrictive loan document, and we're going to do deep diligence, but what we're going to give you is a long-term partnership. So I don't really think we want to disable the sort of durable long-term planning of private solutions. It's part of what makes them a private solution. The other observation I would share is this. Private solutions, if you want them in truly liquid form, it already exists. It already exists. We started this 10 years ago. We have a public BDC, ORCC, and if you want to be a participant in direct lending in fully liquid form, you can buy that. So I'm not sure I know what problem we're trying to solve by creating a bunch of trading in a non-traded underlying asset, but it's certainly true that they're getting more adjacent to each other.
I think it's a fascinating thing to talk about because you think about the largest trading desks on Wall Street, JP Morgan trying to make this happen, Goldman Sachs trying to make it happen. Do you think, especially if you're saying that these markets maybe are private you said they're private for a reason, does that mean that those banks just will not have the supply because firms like you and Ares won't offer it?
I mean, look, we are people that lend and hold the capital, and as you said, I think Ares and many others, follow similar strategies. I don't think it's not our mission to seek liquidity in the asset. Our mission is to make really great long-term loan decisions or long-term commitments to GPs in the case of our GP stakes business, or to Amazon if we're going to be their partner in developing a warehouse. And so I don't really think that we're seeking liquidity. Our job is to be their durable partner. We earn a premium for that. Our investors earn a premium for that. So I think we're quite happy with the structure of the market.
So another place you recently went into, I want to get your thoughts on this because we're sitting in the middle of big tech earnings, a lot of conversation about CapEx spending. You just bought a business to finance data centers. How big is the pipeline there?
That's a really great place to start. So the demand for data center capacity, physical, digital infrastructure, is measured in trillions, right? You were just commenting, I know, on Google, and Google amongst the other large tech companies, they're all on this quest for the digital future. And that digital future is for sure a high growth one and requires a lot of compute power. Now, a data center is not a data center is not a data center. The reason that we acquired IPI, back to my earlier comment on best of breed capabilities, IPI has been doing hyperscale data center focused funds and investing for nearly 10 years now, long before the word hyperscale data center crossed the mind of most people. So it's a trendy topic. My guess is that every person that talks this quarter will use the word data centers. But here's the key. You have to be able to earn the trust of that long-term private partnership with these important hyperscale developers. And that's where IPI is truly distinctive. We have an 800-person operations group as an affiliate of IPI in order to be able to do the power management, the development, the conditioning. That's what the Microsofts and the Amazons and the Googles and the Metas are looking for, and that marries perfectly with our triple net lease business, where today we're a go-to partner of choice for holding the real estate assets of investment-grade counterparties.
Mark, we have to leave it there. We didn't even get to ask you about Tampa Bay. We'll ask
have me
you
back.
those questions offline. Blue Owl Capital co-CEO Marc Lipschultz.